The numbers on your chalkboard aren't just stock prices, they are proofs. You are 23 years old, earning $48,000 annually, and you've never spent a single day working in finance. This is precisely why they want you, drawing you into a world whose ultimate secrets are far more profound than you can imagine. This journey begins at level 1, the PhD student. Your program spans 5, sometimes 6, years, focusing on mathematics, statistics, or physics at an institution whose name carries weight. Think MIT, Princeton, Stanford, Chicago, or Caltech. Your annual stipend ranges from $48,000 to $65,000, tuition is waived, and your health plan covers the essentials. In the city where your program is located, this stipend means sharing an apartment with at least one roommate and sticking to a budget you stop bothering to revise after the 4th month, because revisions prove futile. Your core task is to prove things, not to build models or generate anything measurable in quarterly terms, but to establish fundamental proofs. You teach undergraduate calculus 2 days a week to maintain your funding. Your true work unfolds at the intersection of 2 distinct fields that have yet to develop a shared vocabulary, and that critical boundary forms the heart of your thesis. By year 2, your first paper is published, a narrow, precise result in stochastic processes. Over the next decade, it will be cited by 14 other papers, predominantly in fields you've never even touched, a fact you won't bother to track. In year 3, your thesis begins to take definitive shape. You grasp the answer intuitively long before you can formally prove it. This space between knowing and proving becomes your entire world, occupying you in ways that feel both absolute and utterly normal. Year 4 brings a conference in Boston, where you present the first chapter of your dissertation to an audience of 40 people. Of these, 36 are academics, and 4 are not. One of those 4 approaches you during a coffee break, handing you a card with just a name and an email, no firm listed. He mentions having read your preprint on high-dimensional Markov chain structures, calling it interesting. He uses the word with a particular inflection, the way someone signals a deeper meaning they're not yet ready to articulate directly. That night, you email him. 2 weeks later, the first call arrives. They inquire about your research, your defense timeline, and whether you've considered applications in environments where noise distributions deviate from Gaussian. You haven't, but you say yes anyway. You still don't know the firm's name, what it manages, what it trades, or its size. All you know is that someone beyond academia has engaged with your work and deemed it worthy of a phone call, a validation you haven't experienced in your 4 years within these academic walls, until now. Your defense is still 7 months away, the card remains in your wallet, and you return to your proofs. What you don't realize yet is that you passed the initial filter 3 months before you even knew such a filter existed. That first call wasn't an introduction, it was an evaluation. 6 more calls will follow before anyone dares to utter the word offer. Welcome to Level 2, the junior quant researcher. Following those 6 evaluative calls, you endured 2 intense days of on-site interviews. These included complex probability problems, a 90-minute combinatoric session, and a challenging encounter in a room where a senior researcher presented an unfamiliar derivation, observing your problem-solving process when an immediate answer wasn't apparent. You tackled most of it, though they never disclosed how much you actually solved. The offer arrived 3 weeks later from one of the names you've learned to revere, 2 Sigma, D, Shaw, Citadel. These are the systematic trading firms that value a mathematics doctorate with the same gravity Goldman Sachs places on a Wharton MBA. Your total first-year compensation stands at $420,000, broken down into a base salary of $180,000, an $80,000 signing bonus, and a guaranteed performance bonus of $160,000. You recalculate the figures 3 times. As you deposit the signing check, you feel a sensation closer to disbelief than anything else, because this sum currently lacks any frame of reference. You are 27 years old. Your office houses 20 researchers collectively managing $6 billion. There's no open plan layout, no squawk boxes, no background hum, just people at their desks, surrounded by dual monitors and open notebooks beside their keyboards. The quiet ambience resembles a university, but the output decidedly does not. Your primary role is to uncover signals. A signal, in this context, is a statistical pattern within data that accurately predicts future price movements, with an edge robust enough to absorb transaction costs and decay slowly enough to be worth deploying. While the definition sounds pristine, the actual work is anything but. You dedicate your first 3 months to devouring academic literature on factor models, alternative data sourcing, market microstructure, and risk premium frameworks. You meticulously annotate everything, not because anyone asked you to, but because these annotations are how you construct a comprehensive map of what has already been attempted and failed. Your first signal memo takes 3 weeks to complete. It involves correlating satellite imagery of retail parking lot occupancy with same-store sales surprises, yielding a backtested Sharpe ratio of 1:4. You present it in 11 minutes. The portfolio manager, or PM, reads your one-page summary in 4 minutes flat. He utters a single word, pass. No explanation. You spend 2 days relentlessly trying to pinpoint where it went wrong, but you never find the flaw. Your second memo, however, is different. It identifies a volatility pattern in currency pairs during the 15-minute windows following European Central Bank communications. This represents 12 weeks of intensive work. The PM reads it and simply says, "Interesting." You later discover that, "interesting," is the most positive word he's spoken to any researcher in 6 months. This signal makes it into the book. It runs live for 90 days, holding strong out of sample. You are never told what profit or loss it generates, nobody volunteers that information. To ask would betray a lack of understanding regarding ownership. At the close of your second year, during a team lunch, someone casually mentions a number, the way one references something that needs no context. A signal, developed by a researcher 4 years prior, is still actively running in the book, having generated a cumulative alpha of $340 million. That researcher departed after 2 years and is now at a university in California, writing academic papers. Yet, his signal continues to run. It will keep running. It will run even after he dies. You don't sleep well that night. You're not afraid, you're simply doing the arithmetic. Now, you've reached level 3, the research scientist. The arithmetic from that sleepless night coalesced into a clear directive: signals endure, but you do not. This inherent asymmetry isn't a threat, it's the very essence of your job description. You are 30 years old, and your total compensation this year is $780,000. The number is undeniably real, yet you've stopped truly noticing it. What truly matters is what you are constructing. You now own not just a signal, but an entire strategy, a comprehensive, systematic framework that trades across 44 instruments in 3 distinct asset classes, integrating 31 individual signals under a unified risk model. You didn't originate all 31, some were initiated by researchers who have since moved on. You inherited their code, rigorously tested their underlying assumptions, identified what was no longer valid, and meticulously rebuilt them from the inside out. This isn't merely research, it's closer to archaeological reconstruction. The core challenge at this level revolves around capacity. Your top-performing signal has a ceiling of $200 million in deployable capital. Exceeding this threshold means your positions become so substantial relative to available liquidity that the signal itself begins to move the very market it's attempting to trade, effectively consuming its own edge. You've just dedicated 4 months to developing something whose theoretical ceiling inherently limits its utility to the firm. You present this candidly. The PM offers a single nod. You return to your desk and begin anew. The hours aren't brutal in the way banking hours are, you choose to work 60 hours a week, rather than being mandated. The pressure is internal. 6 months can pass where every single hypothesis you test fails out of sample. The market shifts its regime structure, rendering signals that worked in the previous configuration ineffective in the current one. The work restarts. You author a paper for an internal research conference. It's the finest technical work you've ever produced, yet no one outside this building will ever read it. Then, a recruiter calls. Not for another research role, but for a portfolio manager position at a multi-manager fund with $11 billion under management. He explains you'd run your own book, utilize your own signals, and make your own capital allocation decisions. You inquire about the amount of capital. He replies, "It depends on what you bring." You don't return his call for 3 weeks. When you finally do, you tell him you're not ready. This is the truth. You understand precisely what you still need to achieve before ready holds true meaning in a context where the market assigns the grade, and that grade is permanent. 3 more years, you tell yourself. 3 more years to build this thing before I bet everything on it. After 3 more years, you reach level 4, the senior researcher. You are 33, and your total compensation this year is $1.4 million. Your signals are now integrated into 14 active strategies. While you didn't personally author all 14, you possess a profound understanding of each. You discern which are fragile, which are robust, and which hinge on microstructure conditions that could instantly shift with a single regulatory announcement. You carry this intricate map entirely in your head, as committing it to a single document would pose a severe security risk that the firm treats with utmost gravity. The non-disclosure agreement, or NDA, conversation recurred last spring, not the standard onboarding paperwork, but a significantly more intense version. It involved the firm's attorneys, a small conference room, and lasted 2 hours. The message was clear: every notebook, every model, every line of code, every signal you've developed here belongs irrevocably to the firm. Should you leave, you are prohibited from working in systematic trading for 2 years. Furthermore, you cannot discuss the firm's methods, data sources, signal architecture, or portfolio construction logic in any manner that could be identified as originating from here. You signed without reading beyond page 3. The terms weren't surprising, they were the very structure of this world. What you grasp at this advanced level, something you couldn't have perceived earlier, is that the true alpha isn't found in individual signals. It resides in their combination, the intricate way 31 signals interact through a sophisticated risk model across diverse market regimes, and the correlation structure that binds the entire system together. The portfolio construction layer is where the true intelligence lies, and it is precisely the part of the firm's knowledge base that is least portable, most collaborative, and most challenging to reconstruct anywhere else. You've been privy to discussions about that critical layer, understanding enough of it to be considered dangerous. This is precisely why another pivotal conversation unfolded. One Tuesday afternoon, the PM approached your desk and announced that a new book was opening: Your Own Capital, Your Own Signals, and 10% of the profits generated. He articulated the numbers with the same dispassionate tone one might use to read a departure board. You requested a week. You dedicated that week not to signals, which you already possessed, but to meticulously constructing the comprehensive risk framework you would operate, the drawdown rules, the regime detection protocols, and the escalation procedures for when the model's assumptions are being breached faster than the model can possibly update. You allotted yourself 6 days to identify any insurmountable structural flaw. You found none. On the 7th day, you returned to his desk and said yes. You've arrived at level 5, the portfolio manager. You are 36 years old, and you run $800 million. Not advise, not support, not contribute to someone else's book, you run it. Your base salary is $200,000. That figure, which felt monumental at level 2, here represents merely the fixed cost of your arrangement, alongside 10% of the profits. In a good year, your book generates a 16% return on capital, translating to $128 million in profit and loss. Your share is $12.8 million, potentially higher in an exceptional year. In a bad year, only the base salary sustains you. Nobody manages you, and nobody reviews your memos. Each morning, the terminal opens, positions update, and that update serves as a direct verdict on your thinking. You once lost $31 million over 9 trading days in February when a volatility regime shifted more rapidly than your correlation matrix had anticipated. Your stomach no longer drops, that visceral reaction ceased around month 7. It's simply a number with the wrong sign, demanding a precise sequence of corrective actions. You reduce positions, document the failure of the model's assumptions, update the framework, and return to work. In this industry, being right 52% of the time makes you exceptional. The remaining 48% keeps you rigorously honest. The isolation, however, is a reality nothing could have prepared you for. At the research level, you benefited from the feedback loop of a team, a PM's desk, and internal conferences. Here, there is only your position and the market's daily adjudication of it. Your position is a hypothesis, the market is the ultimate judge. You've been operating this way for 4 years. Your signals have weathered 2 distinct interest rate regimes, 1 credit event, and a sustained period of volatility compression that, by all accounts, should have crippled 3 of your strategies, yet didn't. The machine you've built is genuinely yours. The results are real. Then, at a conference in New York you almost didn't attend, a researcher who departed one of the original systematic firms 9 years prior casually mentions a number during a panel. He states it not as a boast, but as an established fact the room already knows and has implicitly agreed to accept. He speaks of a 66% average annual gross return since 1988, 36 years with 0 losing years. You already knew the number. What truly stunned you was the room's reaction. Nobody leaned forward, nobody asked, how? The number was accepted with the same quiet certainty as a physical constant, a fundamental truth about the world you operate within, immutable and beyond question. You ponder this for the entire flight home. That staggering 66% return over 36 years isn't a number the hedge fund industry produced, it's a number the hedge fund industry has failed to explain for 36 years, and has simply accepted as a permanent fixture. This is the Medallion Fund, and it is not a fund you can invest in. It stopped accepting outside capital in 1993, and its last external investor was bought out in 2005. Since then, the fund exclusively invests employee money, capped at $10 billion to $15 billion, meticulously preserving its unparalleled edge. The 400 researchers in East Setauket, New York, aren't vying for access to it, they are inside it. Every improvement any one of them makes to the model directly enhances their own wealth, because they are all invested in the very same fund. The incentive structure is the architecture. The architecture is the edge. The NDAs they sign are fundamentally different from yours. The restriction isn't merely 2 years in similar roles, it is permanent. It encompasses categories of information so broad that leaving the firm necessitates abandoning not just specific signals, but the entire framework of thinking about markets that the firm has spent 4 decades meticulously building within its researchers. You will never see their model. There is no conference where it is presented, no paper ever published about it. The researchers who built its foundational signals are not celebrities, some have been dead for a decade, yet their signals continue to run. The model seamlessly incorporated their work and persisted without them, because the model is not dependent on the people within it. It is the system. And this system is engineered to outlast its individual components. Every systematic fund you have ever studied, every signal you have ever built, every framework you have meticulously developed across 15 years of research, is merely a local approximation of something they solved globally before the internet even existed. You aren't failing to reach Medallion, you were never in the race to begin with. The race concluded long before you even comprehended what winning it would demand. Somewhere in East Setauket, within a building that discreetly hides its address, a researcher who hasn't left in 21 years is running a new test on a dataset that remains unnamed in academic literature. The result will be integrated into a model you will never see. That model will continue to run for decades after he is gone, as several signals already have. Your terminal displays the Asian session opening. Positions are updating. You check the correlation matrix, review the overnight risk report, and scan for signals approaching their regime boundaries. The machine you have built is real. The results are real. The work is real. Yet, it is also not the best machine. It has never been the best machine. You go back to work.